Welcome to the deep dive.
Mm.
This time we're taking a deep dive into asset management.
Okay.
You sent us a whole stack of articles, research, even some notes.
Mm-hmm.
Looks like you're really trying to get a handle on this.
Yeah.
So whether you're gearing up for a big meeting, making some investment decisions,
So
or just super curious about how money makes money, we're here to break it all down for you.
that's right. And the fascinating thing is asset management isn't just for Wall Street anymore.
Right.
It's knowledge that can empower anyone to make smarter financial decisions in all areas of their life.
Okay, so let's dive into these 10 key insights the source laid out about asset management.
Sure.
Hit me with the ones that our listener absolutely needs to understand to get the big picture.
Well, first off, it's crucial to grasp the concept of different investment strategies and how they cater to different goals and risk tolerance. You know, some people are comfortable with a bit of a roller coaster ride in pursuit of high growth.
Yeah.
They might lean towards investing in tech startups, for instance.
Okay.
Others prefer a smoother journey, even if it means slower growth,
Right.
and might opt for something like bonds.
Okay.
A good asset manager helps you figure out what kind of investor you are and builds a portfolio that aligns with your individual goals and comfort level with risk.
So it's like finding your financial personality and then picking the right outfit for it.
Exactly.
Huh.
It's about tailoring your approach to who you are as an investor.
Okay.
Now, another key takeaway is that risk management isn't just about avoiding losses altogether.
Right.
It's about understanding the relationship between risk and potential return and managing that balance.
Okay.
Higher risk can lead to bigger gains, but it also opens the door to potentially bigger losses.
Right.
Asset managers use various tools and strategies to assess and mitigate risk,
Yeah.
ensuring your portfolio is aligned with your risk tolerance.
That makes sense. I'm curious, though, what kind of tools are we talking about here? Can you give us a peek behind the curtain a bit?
One common tool is diversification.
There we go.
Think of it as the don't put all your eggs in one basket
Right.
principle applied to investing.
Right.
Instead of concentrating your investments in a single asset class,
Yeah.
you spread them across a mix of stocks, bonds, real estate, and perhaps even commodities like gold.
Oh.
This way, if one asset class takes a hit,
Yeah.
the others can help cushion the blow.
So it's about creating a safety net within your portfolio.
Yeah.
Makes sense. But how do they know which mix is right for each person? It seems like it would take a lot of analysis and monitoring.
It absolutely does.
Yeah.
Asset managers constantly track market trends, economic indicators, and the performance of individual assets within your portfolio.
Okay.
They use benchmarks, which are standard measures of market performance, to see how your investments stack up against the overall market. They're essentially the financial gardeners.
Making sure your portfolio is healthy and growing as expected.
Okay, so they're keeping a close eye on things and making adjustments as needed.
Yeah.
But how do they communicate all of this to the investor?
Yeah.
I imagine it can get pretty complex.
Transparency and communication are vital in asset management.
Okay.
Managers typically provide regular reports and updates
Right.
explaining how your investments are performing,
Yeah.
what adjustments they're making, and
Yeah.
why.
Yeah.
They also make themselves available to answer your questions and discuss your financial goals and concerns.
That's reassuring.
Yeah.
I guess it's like having a financial co-pilot, someone who understands the terrain and can help you navigate the ups and downs of the market.
That's a great analogy.
Yeah.
Now, speaking of navigating the market,
Yeah.
the source also highlighted the increasing influence of technology in asset management. We're seeing the rise of robo-advisors and AI-powered tools that are changing the game in terms of accessibility and efficiency.
This is where it gets really interesting for me. Okay. Could you explain how these robo-advisors actually work? Do they just pick investments for you based on some algorithm?
It's a bit more nuanced than that.
Okay.
Robo-advisors use algorithms to create and manage portfolios based on your financial goals, risk tolerance, and time horizon.
Right.
They typically ask you a series of questions to understand your financial situation,
Okay.
and then recommend a portfolio of exchange-traded funds, ETFs, or index funds that align with your needs.
Hold on. ETFs and index funds.
Yeah.
Can you break those down for our listener?
Of course.
Okay.
Imagine a basket filled with a variety of stocks or bonds.
Okay.
That's essentially what an ETF is.
Okay.
They offer a way to invest in a specific sector or market without having to pick individual stocks.
Right.
Index funds, on the other hand, are designed to track a specific market index, such as the S&P 500.
Okay.
They offer broad market exposure and tend to have lower fees compared to actively managed funds.
So ETFs offer flexibility and targeted exposure.
While index funds provide broad market coverage and cost efficiency.
Right.
Got it.
Okay.
But how do these robo-advisors decide which ETFs or index funds are right for each individual?
They analyze your answers to those initial questions, considering factors like your age, income, investment goals, and risk tolerance. The algorithm then selects a mix of ETFs or index funds designed to match your specific profile.
It sounds like a pretty sophisticated process.
It is, and it's becoming increasingly popular, especially among younger investors who are comfortable with technology and appreciate the lower fees typically associated with robo-advisors. But here's the crucial point. While technology can streamline the process and make investing more accessible, it's still essential to understand the fundamentals of asset management.
So it's not a set it and forget it kind of thing. You still need to be engaged and informed about what's happening with your investments.
Absolutely.
Okay.
You need to understand the underlying principles, the risks involved, and your own investment goals.
Right.
Think of it this way. A robo-advisor can be like having a superpowered financial GPS. But you still need to know where you want to go and how to read a map.
Right. You don't want to blindly follow the GPS without understanding the route or potential detours.
Right.
So even with these technological advancements, it sounds like human judgment and financial literacy are still key.
Exactly.
Okay.
Technology can enhance the process, but it doesn't replace the need for human understanding and decision-making.
Right.
And that brings us to another important aspect highlighted in the source.
Okay.
Understanding who the major players are in the asset management world. We're talking about firms like JP Morgan, BlackRock, Vanguard.
Whoa, those are some big names.
Yeah.
It's like the all-star team of money management. What makes them stand out in such a crowded field? Do they each have a specific area of expertise?
You could say that.
Okay.
Each firm has its own strengths and focus areas. JP Morgan, for instance, is a global giant with a vast network and a wide range of investment options, catering to both individual and institutional investors.
So they're like the one-stop shop for all things finance.
In a sense, yes.
Okay.
They offer everything from traditional banking services to wealth management and investment banking.
Okay, what about BlackRock?
Yeah.
They always seem to be in the news.
BlackRock is known for its expertise in exchange-traded funds, or ETFs. They're one of the largest ETF providers globally, offering a wide array of ETFs that track various market sectors, indices, and investment strategies.
So if someone wanted to dip their toes into a specific market or sector, BlackRock's ETFs might be a good place to start.
They certainly could be. But it's important to remember that every investment carries risks. And ETFs are no exception. It's crucial to research and understand the specific ETF and its underlying holdings before investing.
Good point. Always do your homework before you jump in. Now, what about Vanguard? I've heard their name associated with low-cost investing.
That's right.
Okay.
Vanguard is renowned for its index funds and its commitment to keeping costs low for investors.
Right.
They popularized the concept of index fund investing, making it accessible to the masses.
Okay.
Index funds, as we mentioned earlier, aim to track a specific market index, like the S&P 500, providing broad market exposure at a lower cost compared to actively managed funds.
So if someone's looking for a simple, cost-effective way to invest in the overall market, Vanguard might be a good option to explore.
That's a fair assessment.
Okay.
However, remember that even with index funds, it's crucial to understand the risks associated with the specific index and the overall market conditions.
Right. There's no such thing as a risk-free investment, no matter how reputable the firm. And speaking of different approaches, the source also mentions something called ESG investing, which seems to be gaining a lot of traction lately.
What's the story there, and why should our listener care?
ESG stands for environmental, social, and governance factors.
Okay.
It's a way of evaluating companies, not just on their financial performance, but also on their impact on the planet, their treatment of employees and stakeholders, and their ethical practices.
So it's like investing with a conscience.
Yeah.
Putting your money where your values are.
Exactly.
Right.
It's about aligning your investments with your personal beliefs
Yeah.
and supporting companies that are doing good in the world.
That's a really interesting concept.
Yeah.
It seems like ESG investing could be a powerful force for change. But even if our listener isn't actively managing a portfolio or picking individual stocks, are ESG considerations still relevant to them?
Absolutely. ESG factors are increasingly influencing the broader investment landscape.
Okay.
Many mutual funds and ETFs now incorporate ESG principles into their investment strategies.
Giving investors more options to align their portfolios with their values.
Okay.
Additionally, consumers are becoming more conscious of the companies they support,
Right.
often choosing products and services from businesses with strong ESG track records.
So even if you're not directly picking ESG-focused investments,
Right.
you're likely already exposed to them through your retirement funds, mutual funds, or even the products you buy every day.
That's precisely it. ESG is becoming increasingly integrated into the fabric of the financial world.
Yeah.
It's no longer a niche concept.
Right.
It's a growing force shaping investment decisions and corporate behavior.
Wow, that's fascinating.
Yeah.
It seems like ESG is shifting the paradigm, moving beyond just pure financial returns to consider a broader set of values and impacts.
Yes, it's a significant shift.
Okay.
And it reflects a growing awareness that financial success and sustainability go hand in hand.
Well, we've covered a lot of ground in this first part of our deep dive into asset management.
We have.
From understanding different investment strategies and the role of risk management to exploring the world of robo-advisors and the rise of ESG investing.
Right.
We've laid a solid foundation.
We have indeed. And I think it's clear that asset management is no longer just about crunching numbers and maximizing returns.
Right.
It's about aligning your investments with your goals, your values, and your vision for the future.
Okay.
So yeah, it really is a fascinating evolution.
Yeah.
And speaking of evolving, one of the insights that stood out to me from the source material was how much emphasis it placed on the need to constantly adapt and learn in the world of asset management.
That makes sense. I mean, the financial landscape is always shifting.
Yeah.
New technologies emerge, markets fluctuate, regulations change.
Yeah.
It must be like trying to hit a moving target.
It is, and that's why it's so crucial for both asset managers and investors to stay informed and be willing to adjust their strategies as needed.
Yeah.
This isn't a set it and forget it kind of field.
So what does that look like in practice? How does an asset manager stay ahead of the curve?
Well, a big part of it is continuous research and analysis.
Okay.
They need to keep their fingers on the pulse of the global economy.
Yeah.
Understanding how various factors, from interest rates and inflation to geopolitical events and technological advancements, might impact different asset classes and investment strategies.
It sounds like they need to be part economist, part market analyst, and part futurist, all rolled into one.
That's a great way to put it.
Uh-huh.
They need to be able to connect the dots, see the big picture,
Mm-hmm.
and anticipate how different trends might converge or diverge.
And how about the investor side of the equation?
Right.
What can they do to stay informed and adapt to the changing market landscape?
First and foremost, they need to be proactive about educating themselves.
Okay.
There's a wealth of information available online, from financial news websites and blogs to educational resources offered by reputable financial institutions.
Yeah.
And remember, those insights reports we mentioned earlier, those could be a valuable source of information as well.
But you cautioned us about taking those reports with a grain of salt, right? Because they might have a marketing angle.
It's crucial to read those reports critically,
Okay.
understanding that they're often designed to showcase a particular firm's expertise or promote their products and services.
So it's like getting a second opinion, right?
Right.
You wouldn't just rely on one doctor's diagnosis. You might seek out another perspective to get a more complete picture.
That's a perfect analogy.
Yeah.
It's always wise to gather information from multiple sources, compare different viewpoints, and then form your own conclusions.
So staying informed is key for both asset managers and investors. But what about adaptation?
Right.
How do you adjust your strategies when the market throws you a curveball? Yeah.
It comes down to flexibility.
Yeah.
And a willingness to reevaluate your approach.
Okay.
For example, let's say you've built a portfolio heavily weighted towards growth stocks, but the market starts to show signs of slowdown.
Okay.
A skilled asset manager might recommend diversifying into more defensive assets, like bonds, to mitigate potential losses.
So it's about recognizing when a change in course is needed,
Right.
and then having the agility to make those adjustments.
Precisely. And this ability to adapt is becoming even more crucial in today's rapidly changing world.
Right.
Think about the impact of technology, for example. We're seeing innovations like artificial intelligence and machine learning play an increasingly prominent role in asset management.
That's right. We touched on robo-advisors earlier, but it sounds like AI is having a broader impact beyond just automated investing.
It is.
Okay.
AI can be used to analyze vast amounts of data, identify patterns, and generate insights that might not be immediately apparent to human analysts.
Okay.
This can help asset managers make more informed decisions about portfolio construction, risk management, and even identifying new investment opportunities.
So it's like having a super-powered research assistant working tirelessly behind the scenes, punching numbers and spotting trends.
That's a good way to think about it. AI can process information at a speed and scale that humans simply can't match.
That's incredible.
Yeah.
But I imagine there are also concerns about the potential downsides of relying too heavily on AI in asset management.
There are definitely valid concerns.
Okay.
One is the potential for bias.
Yeah.
AI algorithms are trained on vast data sets.
Right.
And if those data sets contain biases, the algorithms can perpetuate and even amplify those biases.
That's a crucial point. It reminds me of that saying, garbage in, garbage out.
Right.
If you feed an AI system biased data, you'll get biased results.
Exactly. So it's essential to ensure that the data sets used to train AI algorithms are as diverse and representative as possible, and that the algorithms themselves are designed to mitigate potential biases.
So there's a responsibility on the developers and users of these AI systems to be aware of these ethical considerations.
Yeah.
But even beyond bias, are there other concerns about AI in asset management?
Another concern is the potential for black box decision-making.
Okay.
Some AI algorithms are so complex that even their creators don't fully understand how they arrive at their conclusions.
That's a bit unnerving. If you're entrusting your investments to an AI system, you'd want to have at least some understanding of how it's making decisions.
Absolutely.
Yeah.
Transparency and explainability are crucial when it comes to AI and finance.
Okay.
Investors need to be able to understand the logic behind the AI's recommendations and have confidence that those recommendations are aligned with their goals and risk tolerance.
So it's not just about the technology itself, it's about how it's used, how it's regulated, and how we ensure that it serves the best interests of investors.
You've hit the nail on the head.
Okay.
It's about striking a balance between embracing the potential of AI to enhance asset management, while also safeguarding against potential risks and ensuring ethical and responsible implementation.
This whole conversation about AI and its impact on asset management is really fascinating.
It is.
It seems like we're still in the early stages of understanding how this technology will shape the future of investing.
We are. It's a rapidly evolving field.
Right.
And it will be interesting to see how it continues to unfold in the years to come.
Well, I have a feeling this isn't the last we'll be hearing about AI and its role in finance.
Probably not.
But for now, let's shift gears a bit and talk about another important aspect of asset management that the source highlighted, the concept of value creation.
Yes. Value creation is at the heart of successful asset management.
Okay.
It's not just about preserving capital or even generating returns. It's about creating tangible value for investors over the long term.
So how does that differ from simply making money? What does it mean to create value in the context of asset management?
It means going beyond just financial metrics like stock price appreciation or dividend payouts.
Okay.
It's about understanding the underlying businesses and assets that make up a portfolio and identifying ways to enhance their value over time.
Can you give us an example?
Certainly. Let's say an asset manager invests in a company that manufactures renewable energy technologies.
Okay.
The company might be financially sound and generating decent returns.
Right.
But the asset manager sees an opportunity to create even more value.
Okay, how so?
They might work with the company's management team to identify ways to improve operational efficiency, expand into new markets, or develop innovative new products.
Okay.
These actions could lead to increased revenue, higher profitability, and ultimately a higher valuation for the company.
So it's about taking an active role, not just being a passive investor.
Exactly. It's about being a strategic partner, leveraging expertise and resources to help companies reach their full potential.
That's a really interesting perspective.
Yeah.
It reframes the role of asset management, making it more about collaboration and building something bigger than just financial returns.
It's about creating a win-win scenario where both the investors and the companies they invest in benefit from a long-term, value-driven approach.
That's a powerful concept. It seems like this idea of value creation could be particularly relevant in the context of ESG investing.
You're absolutely right. ESG considerations are inherently intertwined with value creation.
Right.
When you invest in companies that are committed to sustainability, social responsibility, and good governance, you're not just aligning your investments with your values, you're also investing in companies that are likely to be more resilient and adaptable in the long run.
That makes sense. Companies that prioritize ESG factors are often better positioned to navigate challenges like climate change, social unrest, and regulatory shifts.
Precisely. They're building businesses that are not only profitable, but also sustainable and socially responsible, which can lead to long-term value creation for both the company and its investors.
So it's like a virtuous cycle.
Yeah.
ESG principles drive value creation, and value creation, in turn, reinforces the importance of ESG.
Right.
It's a win-win for everyone involved.
It really is.
Yeah.
And this interconnectedness between ESG and value creation is becoming increasingly recognized by investors and asset managers alike.
I can see why. It's a compelling narrative that goes beyond just maximizing short-term profits and embraces a more holistic and sustainable approach to investing.
And this brings us to another important point highlighted in the source material. The role of stewardship in asset management.
Stewardship. That sounds intriguing. I usually associate that term with taking care of land or property. How does it apply to investing?
In the context of asset management, stewardship refers to the responsibility that investors and asset managers have to manage assets not only for financial return, but also for the benefit of society and the environment.
So it's about recognizing that investments have a broader impact beyond just the bottom line.
Exactly. It's about acknowledging that investors have a role to play in promoting sustainable practices, responsible corporate governance, and positive social impact.
That sounds like a significant shift in mindset from the traditional maximize shareholder value at all costs mentality.
It is. The concept of stewardship recognizes that investors have a duty to consider the long-term consequences of their investment decisions and to use their influence to promote positive change.
So how does this play out in the real world? What are some concrete examples of stewardship in action?
Well, one example is engaging with companies on ESG issues. Investors can use their voting rights to support shareholder resolutions that promote sustainability, diversity, or fair labor practices.
So it's about using their voice and their vote to influence corporate behavior.
Yes. Investors can also engage directly with company management, encouraging them to adopt more sustainable practices or address social or governance concerns.
It sounds like this requires a proactive approach from investors. They need to be informed, engaged, and willing to use their leverage to drive positive change.
Absolutely. Stewardship is not about passive ownership. It's about active participation and using your influence to make a difference.
That's a powerful message. It seems like the concept of stewardship is really transforming the way people think about investing.
It is. It's shifting the focus from purely financial returns to a more holistic approach that considers the broader impact of investments on society and the planet.
Well, we've covered a lot of ground in the second part of our deep dive.
We have.
From the importance of adaptation and the role of AI to the concepts of value creation and stewardship.
And it's clear that the world of asset management is constantly evolving, embracing new technologies, incorporating broader perspectives, and recognizing the interconnectedness between financial performance and social responsibility.
It's been a fascinating journey so far.
It has.
And I'm eager to hear what insights you'll share in the final part of our deep dive.
I'm looking forward to it.
Okay.
We'll be exploring some key trends shaping the future of asset management and discussing what it all means for investors like you.
All right, we're back for the final part of our deep dive into asset management. You've walked us through the fundamentals, the major players, the evolving landscape, and even the ethical considerations. So what's next? What does the future hold for asset management, and what should our listener be paying attention to?
That's a great question. The world of finance is always in flux,
Right.
and asset management is no exception.
Yeah.
But based on the source material you provided and my own observations, there are a few key trends that I think will shape the industry in the years to come.
Okay, lay it on us.
Okay.
What's on the horizon?
Well, first and foremost,
Okay.
I think we'll continue to see the rise of technology and data analytics in asset management.
Okay.
We've already talked about robo-advisors and AI.
Right.
But I believe these tools will become even more sophisticated and integrated into the investment process.
So more algorithms, more data crunching, more automation. Is that what you're seeing?
Yes, but it's not just about automating tasks or replacing human analysts.
Okay.
It's about leveraging technology to gain deeper insights, make more informed decisions, and personalize investment strategies in ways that were previously unimaginable.
That's less exciting.
Yeah.
But I also wonder about the implications for the role of human asset managers.
Right.
Will they become obsolete in this increasingly tech-driven world?
That's a question many people are asking.
Yeah.
While technology will undoubtedly reshape the profession,
Okay.
I don't believe it will completely replace human asset managers.
Right.
Instead,
Okay.
I think it will augment their capabilities and allow them to focus on higher value activities that require human judgment, creativity, and empathy.
So it's not about humans versus machines.
Right.
It's about humans working with machines to achieve better outcomes for investors.
Exactly.
Okay.
Think of it as a collaboration where technology provides the tools and insights,
Right.
and human asset managers provide the strategic direction,
Okay.
the relationship building skills,
Yeah.
and the ability to navigate the complexities of the market with wisdom and discernment.
That makes sense. It's like having a co-pilot who can handle the technical aspects of flying while the human pilot focuses on the big picture and the overall strategy.
That's a great analogy.
Yeah.
Now, another trend I see gaining momentum is the increasing demand for personalized investment solutions.
Okay.
Investors are no longer content with cookie-cutter portfolios. They want solutions tailored to their unique financial goals, risk tolerance, and even their values.
This ties back to what we were talking about earlier with ESG investing, right?
Precisely.
Okay.
And this trend is driving innovation in areas like impact investing, where investors seek to generate both financial returns and positive social or environmental outcomes.
Okay.
We're also seeing the rise of thematic investing, where investors can align their portfolios with specific themes or trends they believe in, such as renewable energy, artificial intelligence, or healthcare innovation.
So it's about moving beyond traditional asset classes like stocks and bonds and investing in ideas and solutions that resonate with investors on a personal level.
Exactly. It's about aligning your portfolio with your passions and your vision for the future.
That's really exciting. It feels like asset management is becoming more accessible, more personalized, and more aligned with individual values. What other trends are you seeing on the horizon?
Well, one that I think is particularly interesting is the growing focus on alternative investments.
Alternative investments?
Yeah.
What does that encompass?
It's a broad category that includes assets outside of traditional stocks and bonds.
Okay.
Examples include private equity, real estate, hedge funds, commodities, and even collectibles like art or vintage cars.
Okay, so it's about diversifying beyond the usual suspects and exploring different avenues for potential growth.
Yes. But it's important to note that alternative investments often come with higher risks and lower liquidity than traditional investments.
Yeah.
They're not suitable for everyone.
Right.
And investors need to do their due diligence and understand the potential risks and rewards before venturing into this territory.
That's a good reminder. Not all investments are created equal. Right.
And it's crucial to understand the nuances and potential pitfalls before diving in.
Absolutely. Now, another trend I'm observing is the increasing importance of sustainability in asset management.
We've talked a lot about ESG investing, but it sounds like you're seeing sustainability becoming even more deeply integrated into the industry's DNA.
That's exactly right.
Yeah.
It's no longer just about checking boxes or incorporating ESG factors as an afterthought.
Right.
It's about embedding sustainability principles into every aspect of the investment process.
Okay.
Due diligence and portfolio construction to risk management and performance measurement.
So it's about moving beyond ESG as a separate category and making it an integral part of how asset management is practiced.
Precisely. It's about recognizing that sustainability is not just good for the planet.
Right.
It's also good for business.
Okay.
Companies that prioritize sustainability are often more innovative,
Yeah.
more resilient,
Mm-hmm.
and better positioned to thrive in the long term. That makes sense. Investors are realizing that supporting sustainable practices isn't just about doing good.
Yeah.
It's also about making smart investment decisions.
It's about aligning financial performance with environmental and social responsibility.
Right.
Creating a win-win scenario for investors, companies, and the planet.
Wow. This has been a truly eye-opening deep dive into the world of asset management.
It has.
You've given us a lot to think about, from the fundamentals to the future trends and the ethical considerations.
Yeah.
Before we wrap up,
Okay.
is there any final piece of advice you'd offer our listener as they navigate this complex and ever-evolving landscape?
I think the most important thing is to remember that asset management is a journey, not a destination.
Yeah.
It's about continuous learning, adapting to change, and staying true to your financial goals and values.
Okay.
Don't be afraid to ask questions.
Yeah.
Seek out expert advice and make informed decisions that align with your unique circumstances.
That's great advice. It's a reminder that we're all in this together, constantly learning and evolving as we navigate the world of finance.
Yeah.
Well, on that note, I think it's time to wrap up this deep dive.
Right?
We've covered a lot of ground.
We have.
And I hope our listener feels empowered to make smarter financial decisions and shape their own financial future.
Me too.
And a big thank you to our listener for providing the source material that sparked this fascinating conversation.
Yes, thank you.
Remember, whether you're a seasoned investor or just starting out, the journey of financial literacy is an ongoing adventure.
Yeah.
Keep exploring, keep learning, and keep striving to create a financial future that aligns with your dreams and values.
That's right.
Until next time, happy investing.
Happy investing.